Welcome back to the deep dive. Today we're jumping into regression analysis and financial beta.
That's right.
Now, I know these terms might sound a bit textbooky,
A little intimidating, maybe?
but honestly, they're super powerful tools,
Yes.
especially for understanding finance.
Absolutely. And we're going to break them down, show you how they connect, and why they actually matter in the real world.
Great. So our mission today is to really demystify these.
Yep. We'll start with regression basics, then bridge right over to beta. By the end, you should feel pretty comfortable with what they are and how they work.
Fantastic. Okay, let's kick off with part one, laying the foundation, understanding regression analysis.
Right.
So regression, think of it like being a statistical detective.
That's a good way to put it. It's all about finding and measuring relationships between things, between variables.
Variables. Okay, so you have different types.
Yeah, fundamentally, you have the dependent variable.
Yeah.
That's the outcome, the thing you're trying to explain or predict. And then you have the independent variable, or variables. These are the factors you think might be influencing that outcome.
Can we make that more concrete? Maybe an example.
Sure. Let's think about ice cream sales.
Okay, I like ice cream.
Right. So the number of ice creams you sell each day, that could be your dependent variable. It depends on something else.
And the independent variable might be?
Temperature. The daily high temperature. That's your
Right.
independent variable. You think it influences ice cream sales.
Makes sense. Hotter day, more ice cream. So regression helps us.
What? Confirm that link.
Exactly. First, it helps confirm if your hunch is right. Is there actually a statistical relationship? Second, it measures how strong that relationship is and which direction positive in this case.
Higher temp, higher sales.
Precisely. And third, it can even help you predict. If you know tomorrow's forecast, regression could give you an estimate of sales.
Interesting. So it's about quantifying that relationship. Are there different kinds of this regression?
Yes. The simplest, and the one that's key for understanding beta, is simple linear regression. Simple because
Just one independent variable influencing one dependent variable, like temperature and ice cream sales.
and linear.
Because we assume the relationship can be basically represented by a straight line.
Okay. What if other things affect ice cream sales, like holidays or something?
Good point.
Yeah.
That's where multiple linear regression comes in. You'd add more independent variables, temperature, maybe day of the week, if there's a local event.
Gotcha. But for beta, simple linear is enough.
For understanding the core concept of beta, yes. Simple linear regression is the foundation.
Okay. So one influencer, one outcome, looking for a straight line connection. How do we even start to see if there's a connection?
The first step is usually visualization. You create a scatter plot.
A graph with dots.
Exactly. Put your independent variable temperature on the horizontal x-axis. Put your dependent variable ice cream sales on the vertical y-axis. Each day's data is one dot on the graph.
Okay, I'm picturing it. Lots of dots. What am I looking for?
You're looking for a pattern. Do the dots generally trend upwards from left to right?
Which would mean?
As temperature increases, sales also tend to increase. That's a positive linear relationship.
And if they trend downwards?
Like maybe hot chocolate sales versus temperature, that would be a negative linear relationship. As temperature goes up, sales go down.
Right. What if they're just all over the place? No clear trend?
Then maybe there's no linear relationship or it's very weak.
Okay, so let's say we do see a trend in our ice cream example. Dots going up. What's next?
Then we try to draw the line of best fit, or the regression line.
The line that kind of slices to the middle of the dots?
That's the idea. Regression analysis mathematically finds the one straight line that best represents that overall trend. It's the line that minimizes the overall distance from all the points to the line.
How does it minimize the distance?
It specifically minimizes the sum of the squared vertical distances from each data point to the line. It's a method called ordinary least squares, or OLS.
OLS, okay. Sounds technical, but the idea is finding the line that fits best.
Exactly. It's the standard way to do it.
And every line has an equation, right? Y equals something.
Precisely. The equation for a simple linear regression line is typically written as y equals a plus bx plus e.
Okay, let's break that down. Y is our ice cream sales. X is the temperature. What's A?
A is the intercept. It's the predicted value of y when x is 0. Graphically, it's where the line hits the y-axis.
So in our example, sales when the temperature is 0 degrees.
Theoretically, yes. If A was, say, 20, the model predicts 20 sales at 0 degrees. But you always have to ask if the intercept makes practical sense in the context. Selling ice cream at freezing might be low.
Good point. Context matters. What about B? That feels important.
It's crucial. E is the slope of the line. It tells you how much you expect Y to change for a 1-unit change in X.
So for every 1 degree increase in temperature,
B tells you how many more ice creams the model predicts you'll sell. If B is, say, 10, then a 1-degree rise means 10 more sales. If B was only 2, the impact of temperature is less strong.
so B measures the sensitivity, the strength, and direction of the effect.
Exactly. A positive B means Y goes up as X goes up. A negative B means Y goes down as X goes up.
Got it. And the last piece, E,
E. That's the error term, or the residual.
the leftover bit.
Kind of. Look, the line is a model, an approximation. Real-world data points rarely fall exactly on the line.
Right.
E represents the difference between the actual sales on a given day and what the line predicted for that day's temperature. It captures everything else that affects sales but isn't in our simple model. Holidays, promotions, maybe a new competitor opened up,
Yeah.
all that random stuff.
So the regression uses past data to figure out the best A and B,
Yes, it estimates those parameters from your historical data.
giving us an equation to understand the relationship and maybe predict things. But how do we know if this equation is any good if the line is a decent fit?
Excellent question. That's where we assess the model's quality. Two key things to look at are R-squared and statistical significance.
R squared, I think I've heard of that. What does it tell us?
R-squared, or the coefficient of determination, tells you what proportion of the variation in your dependent variable, Y, ice cream sales, is explained by the variation in your independent variable, X, temperature, using your model.
Okay, proportion explained. It's a percentage.
Yep, usually shown as a value between 0 and 1, or 0% to 100%. And R-squared of 0 means temperature explains none of the variation in sales. And R-squared of 1, or 100%, means it explains everything.
Which never really happens in real life, right?
Almost never, especially in social sciences or finance. If our ice cream example had an R-squared of, say, 0.65,
That means 65% of the ups and downs in ice cream sales are explained by temperature changes.
according to our model, yes. The other 35% is due to those other factors in the error term E.
Is 65% good?
Well, good really depends on the context in the field. In some areas, even 30% might be useful, but generally higher is better, suggesting a tighter fit. Just be a bit careful with multiple regression adding more variables. Even useless ones can sometimes inflate R-squared.
Ah, okay. Good to know. What about the other thing? Statistical significance. Sounds important.
It is very important. We found a slope B. But is that slope really different from 0? Or could we have just gotten that result by random chance, even if temperature has no real effect on sales?
How do we know?
Statistical software gives us a p-value for the slope coefficient B. The p-value is the probability of seeing a relationship as strong as the one we found if, in reality, there was no relationship at all.
So we want that probability to be low.
Exactly. Very low. A common cutoff is 0.05 or 5%. If the p-value is less than 0.05, say 0.01, it means there's only a 1% chance we'd observe such a strong link if it was just random luck.
So we can be more confident it's a real effect.
Yes, we'd say the slope is statistically significant. We're reasonably confident that temperature genuinely influences sales. You might also see a t-statistic, basically the coefficient divided by its standard error. A larger t-stat, often above 2 or below -2, also indicates significance.
Okay, significance tells us if the relationship is likely real. R-squared tells us how much our variable explains. Can we run through one more quick non-finance example?
Sure. Let's say study hours and exam scores.
Okay. Study hours is X, exam score is Y.
Right. You run a regression and get it. Exam score 30 plus 5. Study hours.
All right. So A is 30. Maybe that's like baseline knowledge even if you don't study.
Could be interpreted that way, yeah. And B is 5.
Meaning each extra hour of studying predicts a 5-point increase in the score.
According to this model, yes. Now, let's say R-squared is 0.40 or 40%.
So study hours explain 40% of the difference in scores. Other things matter too, like sleep, aptitude.
Exactly. And if the p-value for that slope of 5 is, say, 0.001.
Very small, less than 0.05.
Right. So we're confident that study hours have a statistically significant positive effect on exam scores in this data.
Okay, I think I've got a decent handle on regression now, measuring relationships, checking if they're real, seeing how much is explained. So how does this link to finance and beta?
The perfect segue. Because that slope, that measure of sensitivity, that is the key to unlocking financial beta.
All right, part 2, bridging to finance, introducing beta, the financial superstar. So what is beta in finance? Not just a Greek letter, I assume?
Definitely not. In finance, beta, usually written as BO, is primarily a measure of volatility. Specifically, it measures a stock's or a portfolio's systematic risk relative to the overall market.
Systematic risk. Let's quickly define that again versus the other type.
Sure, total risk has two parts. Systematic risk, or market risk, affects pretty much the whole market. Think interest rate changes, inflation, recessions.
The big picture stuff you can't really avoid just by diversifying stocks within that market.
Exactly. It's undiversifiable market-wide risk. The other type is unsystematic risk.
Also called
Specific risk, idiosyncratic risk. It's risk unique to a company or industry. A factory fire, a drug trial failing, a management scandal.
stuff you can reduce by diversifying, holding lots of different stocks.
Precisely. If one company has a problem, another might do well, offsetting it. Diversification tackles unsystematic risk.
And beta measures.
Beta focuses only on the systematic, market-wide risk. It tells you how much an asset tends to move when the whole market moves.
Okay, so how do we calculate it? I'm guessing regression comes back into play here.
You bet it does. Beta is calculated using simple linear regression. Here's the setup.
Go on.
Your dependent variable, y, is the historical returns of the specific asset you care about, like a stock or a mutual fund.
Returns meaning price changes plus dividends.
Yep, the total percentage change over a period, daily, weekly, monthly.
Okay, and the independent variable, x.
That's the historical returns of a broad market index over the same period, like the S&P 500 in the US or the FTSE 100 in the UK. It represents the market.
So you pick an index that's relevant for the stock you're looking at.
Ideally, yes. A large US company, use the S&P 500. A UK company, maybe the FTSE.
Okay, so you gather the return history for the stock and the market index, run the regression. What does the equation look like now?
It looks very familiar. Stocks return equal I plus I, markets return plus E.
So market return is X, stock return is Y. What are alpha and beta, auto here, and is still the error?
E is still the error term, yes. In this context, it represents the unsystematic, company-specific risk. The part of the stock's return not explained by the market.
Okay, what about alpha, the intercept?
Alpha, sometimes called Jensen's alpha, is the intercept here. It represents the stock's return that's not predicted by the market's return and the stock's beta. Think of it as a measure of risk-adjusted outperformance or underperformance.
So a positive alpha is good, means it did better than expected given the market.
Generally, yes. A consistently positive alpha suggests skill or some other edge. It's what active managers strive for.
Highly sought after, I imagine. Now, the big one, data in this equation.
Beta here is the financial data. It's the slope of this regression line. Just like B told us how sensitive Y was to X, beta tells us how sensitive the stock's returns are to the market's returns.
So it's the expected percentage change in the stock for a 1% change in the market.
Exactly that. It quantifies that systematic risk exposure.
Wow. Okay, so when I see a beta number listed for a stock on a finance website, that number came from this regression analysis. It's the slope.
That's precisely where it comes from. It's the slope B when you regress stock returns on market returns.
Okay, that connection is crystal clear now. How do we interpret these beta numbers? What does a beta of 1 mean?
A beta of 1 means the stock, on average, tends to move in line with the market. Market up 10%, stock up around 10%, market down 5%, stock down around 5%. Broad market index funds usually have betas very close to 1.
What about higher than 1, like 1.5?
Beta greater than 1 means more volatile than the market.
Yeah.
Higher systematic risk. A beta of 1.5 suggests if the market moves 10%, the stock might move 15% in either direction.
So bigger swings. What kinds of stocks have high betas?
Often things like high-growth tech stocks, companies sensitive to economic cycles like airlines or automakers or maybe smaller companies, sometimes called aggressive stocks.
Okay. And less than 1, say 0.7.
Beta less than 1, but still positive, means less volatile than the market. Lower systematic risk. If the market moved 10%, a stock with beta 0.7 might only move 7%.
Examples.
Think utilities, consumer staples companies, selling necessities people buy regardless of the economy, often called defensive stocks.
Makes sense. What about beta equals 0? Is that possible?
Theoretically, yes. It means no correlation with market movements. The classic example is a short-term government treasury bill. Its return is considered risk-free and independent of the stock market.
And negative beta, like negative 0.5, moving opposite the market.
Exactly. Market up 10%, the stock might go down 5%. Market down 10% might go up 5%. Some assets like gold are sometimes thought to behave this way, acting as a safe haven. Some complex strategies might target negative beta too, but it's less common for typical stocks.
This is super helpful for understanding risk relative to the market, but you mentioned it's historical.
Crucial point. Beta is calculated using past data. It tells you how a stock did behave. It's a good estimate, but not a guarantee of future behavior. Companies change, markets change, so beta can change too.
So use it, but with caution. Got it.
Okay, before we dive deeper into how we actually use this information, a quick break. If you're finding this exploration into regression and beta helpful, don't forget to like and subscribe to the Sina YouTube channel for more in-depth discussions on finance and economics. Welcome back. We've established what beta is, how it comes from regression. Now, part 3. Significance and applications. Why do we care about this number? How is it actually used?
Well, beta is really fundamental in finance. One major application is in the capital asset pricing model, the CAPM.
CAPM. Wait, heard that one a lot. What's the core idea?
CAPM is a model designed to figure out the theoretically required rate of return for an investment, given its systematic risk, which we measure with beta.
Required return, meaning what return should you expect to get for taking on that level of risk?
Exactly. It tries to quantify the compensation you should demand for bearing market risk. How does it calculate that? Is there a formula?
There is. It's expected return, risk-free rate, plus beta. Expected market return, risk-free rate.
Whoa, okay. Let's unpack that. Risk-free rate, like a government bond yield.
Yep, the return on a super safe asset. Then you have beta for the specific stock or asset.
Right.
Then the part in the brackets, expected market return minus the risk-free rate. That's called the market risk premium.
The extra return you expect just for being in the market versus holding something risk-free.
Precisely. And beta's job in the formula.
It adjusts that market risk premium based on the specific stock's risk.
You got it.
Yeah.
It scales the market risk premium up or down. If beta is 1, you require the risk-free rate plus the full market premium. If beta is 2, you require the risk-free rate plus twice the market premium. If beta is 0.5, you require the risk-free rate plus only half the market premium.
So higher beta means you should demand a higher expected return to compensate for the higher risk.
That's the core logic of CAPM.
How is CPM actually used? By investors, companies?
Yeah, both. Investors might use it to estimate a fair return for a stock. If they think the stock will actually return more than the CAPM suggests it should, they might see it as undervalued.
And companies?
Companies often use CAPM to calculate their cost of equity, basically, the return shareholders require. This is vital for making decisions about investing in new projects. Does the project's expected return beat the cost of funding it?
Okay, so beta is key for valuation and corporate finance decisions. What about building an actual investment portfolio?
Beta is hugely important there too. First, you can calculate the beta of your entire portfolio.
Just average the betas of everything in it.
A weighted average based on how much of each asset you hold. So if your portfolio beta is, say, 1.2, you know your portfolio is expected to be about 20% more volatile than the market.
So you can use beta to target a certain risk level for the whole portfolio.
Absolutely. Someone risk-averse, maybe nearing retirement, might aim for a portfolio beta below 1. A younger investor might be okay with a beta above 1, hoping for higher returns over time.
So it helps with portfolio construction based on risk tolerance. Does it help with diversification, too?
Well, remember, beta only measures systematic risk. Diversification is about reducing unsystematic risk, the company-specific stuff. So beta tells you about your market exposure, but you still need to diversify across different sectors and assets to handle the other risks.
Got it. Any other portfolio uses?
Yeah, hedging. If you know your portfolio's beta, you can figure out how much you might need to hedge against overall market downturns. Also, performance evaluation.
How so?
You can't just look at raw returns. You need to adjust for risk. Was a high return achieved by taking huge market risks? High beta. Metrics like the Trainer ratio and Jensen's alpha use beta to assess risk-adjusted performance.
Okay, this is making data seem incredibly useful, but earlier you mentioned caveats. When we're looking up a beta, what practical things should we watch out for?
Good question. It's definitely not just plug and play. First, which market index was used to calculate the beta?
Ah, right. S&P 500 versus FTSE versus something else.
Exactly. The beta of a stock can be different depending on the benchmark. You want an index that's relevant to the asset. Using the S&P 500 for a tiny Japanese stock might not give you a meaningful beta.
Makes sense. What else?
The time period and data frequency matter too. Was the beta calculated using 2 years of daily data, 5 years of weekly data, 10 years of monthly data?
And different choices give different betas.
They can, yeah.
Yeah.
Shorter periods reflect recent conditions but might be noisy. Longer periods are smoother, but might include outdated info if the company changed a lot. There's a trade-off.
Okay. And beta isn't fixed forever, you said.
Definitely not. Companies evolve, Industries change, leverage changes. Beta can drift over time. Historical beta is just an estimate of current or future beta.
Anything else about the calculation itself?
Well, it's worth checking the stats from the regression if you can find them.
Yeah.
Was the beta estimate statistically significant?
Like, was the p-value low?
Right. If not, the beta might not be reliable.
Yeah.
And what was the R-squared?
How much the market explained the stock's moves?
Yeah. If R-squared is really low, it means most of the stock's volatility was not related to the market. So beta might not be the best measure of its total risk. Think of a biotech stock driven by drug trial news. Its R-squared against the market might be tiny.
That's a great point. If R-squared is low, beta tells only a small part of the story. Are there ways analysts try to improve on standard historical beta?
Yes. Some use adjusted beta. It nudges the historical beta towards 1.0 based on the idea that betas tend to regress towards the average over time. A common formula is like 23 historical beta plus 13 1.0.
Interesting adjustment. Anything else?
There's also fundamental beta, which tries to estimate beta based on the company's characteristics, its industry, size, debt levels, rather than just its past stock price movements.
Okay, so lots to consider beyond just the headline beta number, which brings us nicely to part 4. Caveats, limitations, and looking beyond beta. It's not a perfect tool.
Far from it. Remember, the regression itself has assumptions.
Like the relationship being linear.
Right. Linearity, independence of errors, constant error variance. If those assumptions don't hold well for the data, the beta estimate might be flawed.
And R-squared limitations, too, doesn't mean causation can be low, even if the model is okay.
Exactly. And focusing specifically on beta and CAPM, we hit more limits. We know beta is historical, depends on the index, but a big one is that CAPM is a single-factor model.
Meaning it assumes only market risk. Beta matters for expected returns.
Yes, but research, like the FAMA French model, suggests other factors systematically affect returns too.
Like company size and value. Small stocks and high book-to-market stocks tending to outperform.
Precisely. FAMA French added size, S&P small minus big, and value, HML high minus low, book-to-market factors. And since then, other factors like momentum, profitability, investment quality have also been proposed.
So reality is likely more complex than just beta. Multi-factor models might explain returns better.
That's the idea behind them, yes. CAPM also relies on assumptions like perfectly rational investors and frictionless markets, which aren't fully realistic.
And estimating beta precisely can just be hard sometimes.
Especially for individual stocks with lots of unique news or shorter histories. The statistical uncertainty around the beta estimate can be quite large.
So given all these limitations, why is beta still so widely used?
Honestly, because it's intuitive, relatively easy to calculate and understand, and there isn't a simple, universally accepted replacement that works definitively better in all situations. It provides a useful first approximation of market risk.
Okay, it's a valuable starting point, but we need to be aware of the rough edges and the bigger picture.
Absolutely. Use it intelligently, not blindly.
Right. Let's wrap things up then, part 5. Conclusion, regression, and beta in perspective.
So we started with regression, the statistical engine using YA plus BX plus E to quantify linear relationships. We saw how the slope B measures sensitivity.
And we looked at scatter plots, the line of best fit, R-squared for explanatory power, and p-values for significance. Real detective work.
Then we saw how that slope B becomes financial beta when we regress asset returns against market returns. Beta measures systematic, market-related risk.
We learned how to interpret beta. One is market-like, one is more volatile, one is less volatile.
And we covered its key uses in CAPM to estimate required returns, and in portfolio management for risk assessment, construction, hedging, and performance checks.
But crucially, we acknowledge the assumptions and limitations. Regression isn't perfect, beta is historical, CAPM is simplified. They're powerful tools, but need critical understanding.
Exactly. Understanding that link from the stats of regression to the finance of beta lets you use beta much more thoughtfully. You're not just taking a number at face value.
So maybe a final thought for you, our listener. As you think about your own investments and risk comfort level, how can understanding beta, its meaning, its calculation, its limits, help you make more informed choices about your portfolio? Maybe it even inspires you to look into risk-adjusted returns or those multi-factor models we mentioned.
That's a great takeaway. Thinking beyond the single number.
Well, thank you so much for joining us on this deep dive into regression analysis and financial beta. We really hope it shed some light on these concepts.
Hope it was helpful.
Keep exploring, keep learning. Until our next deep dive, stay curious.